If you are listening to this, you are likely approaching the most dangerous financial window of your life. I am not talking about a market crash. I am not talking about a recession. I am talking about a structural misalignment in your own portfolio. For the last 30 or 40 years, you have been a builder. You have been trained to chase growth. You have been told that risk is the price of admission for returns. And for the accumulation phase of your life, that was largely true. But the day you retire, the physics of your money changes. I have spent 4 decades managing capital for the largest institutions in the world. Pension fund managers, sovereign wealth directors, family offices that manage multi-generational fortunes. We do not think about getting rich. We think about solvency. We think about the permanence of capital. Most individual investors walk into retirement with the exact same portfolio they used to build their wealth, holding assets designed for a 20-year horizon, not for immediate income stability. This is a mistake that destroys retirements. I saw it destroy lives in 2000. I watched it liquidate entire family fortunes in 2008. You are holding assets that carry risks you can no longer afford to take. Assets that look good on a balance sheet, but are toxic for cash flow. Today, I'm going to walk you through the 5 specific asset classes that you must sell or significantly reduce before you retire. This is not about timing the market. This is about structural hygiene. If you enter retirement holding these 5 assets, you are exposing your life's work to forces that can wipe you out in under 5 years. When you manage a pension fund for 100,000 retirees, you have liabilities to pay every single month. If the market drops 30% and stays down for 3 years, a young investor simply waits. A retirement must sell depreciated assets to pay for groceries and healthcare. This is sequence of returns risk. When you get your returns matters just as much as what the returns are. If you retire and the market drops 20% in your first year, and you are forced to withdraw 5% of your portfolio, you are digging a hole you will never climb out of. Your portfolio is not a scoreboard. It is a utility. It must produce reliable inflation-adjusted cash flow for 30 years. You must ruthlessly cull the assets that do not serve this purpose. Asset class number 1, the illiquid opportunity. The first asset is the illiquid alternative investment. The private equity deal your brother-in-law got you into. The angel investment in a startup. The raw land that will be developed in 10 years. The non-traded REITs with strict lockup periods. In your working years, illiquidity allows you to capture extra returns. But in retirement, liquidity is oxygen. I have seen scenarios in 2008 where high net worth individuals had millions on paper, but the market froze. When the market freezes, you cannot eat internal rate of return. You cannot pay health insurance with a private equity valuation. If you enter retirement with wealth locked in assets, you cannot convert to cash within 2 days. You are taking on unacceptable risk. Life is unpredictable. You may need $50,000 for a medical emergency. If your money is locked in a 7-year private deal, you are helpless. You must begin unwinding these positions 2 to 3 years before you retire. Sell the raw land. Exit the angel investments. You might say, but I'm giving up the upside. I will tell you what I tell institutional clients. At this stage, you do not need a lottery ticket. You need a paycheck. When you are retired, you want assets that are liquid instantly. Treasury bonds, blue chip equities, liquid ETFs. If you can't sell it with a click, ask yourself, can I afford to hold this if the world shuts down for a year? If the answer is no, sell it now. Asset class number 2, the high beta speculative growth stock. These are the companies that make headlines. The disruptors, the unprofitable tech companies, the cryptocurrencies, stocks that go up 50% in a year and down 40% the next. In finance, beta measures how much a stock moves relative to the market. During your accumulation phase, these assets were your engine. You bought Amazon in 2002. You bought Tesla early. You feel loyalty to these names because they made you rich. But the asset that makes you rich is often the asset that keeps you poor in retirement. Here is the brutal math. If you hold a speculative portfolio and it drops 50%, you need 100% gain just to get back to even. If you are 35 and working, you have income to buy the dip. If you are 65 and withdrawing money, a 50% drop is a death blow. Say you have 1 million in speculative tech stocks. A crash happens. Your portfolio falls to 500,000, but you still need 40,000 a year to live. That withdrawal represents an 8% rate on your remaining balance. You are cannibalizing your principal at an unsustainable rate. Even if the market recovers 5 years later, you will have depleted so much share count that you will never participate in the recovery. For a retiree, we want low volatility. I am not telling you to sell all your stocks. Sell the speculative ones. Sell companies that do not make a profit. Sell companies trading at 100 times earnings. Replace them with quality, strong balance sheets, consistent earnings, dividend growth. Companies that sell toothpaste, healthcare, insurance, boring companies. Boring is beautiful. When you are retired, excitement is expensive. If you wake up and your heart races checking a stock price, you are overallocated to speculation. Sell it. Asset class number 3, the concentrated stock position. I see this constantly with executives and employees. You worked at General Electric for 30 years. You accumulated stock options. Or you inherited a massive block of bank stock from your grandfather. You hold it because of taxes. You hold it because of loyalty. Concentration is the fastest way to get rich and the fastest way to stay poor. Let me tell you about Enron employees, Kodak retirees, General Electric loyalists, the most valuable company in the world that then lost a massive percentage of its value. If more than 5 or 10% of your net worth is in a single stock, you are carrying a bomb in your portfolio. I often hear, but the capital gains tax. If I sell, I pay 20% to the government. Let me give you wisdom from 40 years on Wall Street. I would rather pay 20% tax on a profit than take 100% loss on principal. Do not let the tax tail wag the investment dog. Diversification is the only free lunch in finance. If you hold the S&P 500, one goes bankrupt, you barely notice. If you hold one company and it faces a scandal, your retirement is over. You do not have to sell all at once. Sell covered calls against the position, or set a schedule. Sell 10% every quarter until the position is under 5% of your portfolio. Do not be the retiree who lost everything because they were loyal to a stock ticker. The stock does not know you own it. It does not care about you. Treat it as inventory. If the inventory is too heavy, liquidate it. Asset class number 4, the long duration nominal bond. This is where most retirees get hurt because they think they are being safe. The fourth asset to sell is long duration nominal bonds. If yields are low and inflation is structural, traditionally, the advice was own your age in bonds. If you are 60, have 60% in bonds. But you must understand what a bond is. A promise to pay you a fixed amount in the future. If you buy a 30-year bond paying 3% and inflation averages 4%, you have guaranteed yourself a loss of purchasing power. You are safely going broke. We are entering an era of structural inflation. Deglobalization, decarbonization, demographics are all inflationary forces. If you hold long-term bonds, you face 2 risks. Purchasing power risk. The money you get back buys less. And interest rate risk. If rates rise to fight inflation, the price of your bonds crashes. We saw this in 2022, where safe bond portfolios dropped 15 to 20%. You need fixed income, but you need resilient fixed income. Get out of the long end of the curve. Move to short duration bonds. 1 to 3 years, less sensitive to rate spikes. Look at TIPS, Treasury inflation protected securities. Look at high quality corporate credit with shorter lifespans. Do not blindly buy a total bond market fund. In a rising rate or high inflation environment, long duration bonds are a trap. They offer return-free risk. Cash and short-term bills allow you to reinvest at higher rates if rates go up. Long bonds lock you into a mistake for decades. Asset class number 5, the depreciating lifestyle asset. The fifth asset is not a stock or bond. It is a physical liability that masquerades as an asset, the oversized primary residence or vacation home. You have heard your home is your biggest asset. From a retirement cash flow perspective, your home is a liability. It does not pay you. You pay it. Property taxes, insurance, maintenance, heating, cooling, landscaping. The number one cause of liquidity stress in retirement is being house poor. A $2 million house and $500,000 in the bank. The house eats 40% of monthly income just to keep the lights on. When you retire, ruthlessly audit your carry costs. If you live in a 4,000 square foot home with 4 empty bedrooms, you are paying to heat air for ghosts. Downsizing is not a failure. It is strategic liberation of capital. Imagine you sell the big house, buy a smaller place and free up $500,000 in equity. That $500,000 in a conservative portfolio yielding 5% generates $25,000 a year. Simultaneously, you reduce property taxes and maintenance by $15,000 a year. That is a $40,000 annual swing in your favor. The difference between a stressful retirement and a luxurious one. Do not let your ego keep you in a house that drains your freedom. Now that we have identified the 5 assets, we must discuss the psychology of selling. Why do we hold on? Loss aversion, endowment effect, identity. You must strip your identity away from your assets. As a global asset manager, I have no emotional attachment to positions. If the data changes, we sell. If the macro environment shifts, we rotate. You must adopt this professional detachment. Think about your future self, the version of you that is 80 years old. Does that version care you? Held a volatile tech stock hoping for a double? No. They care about dignity, being able to afford the best medical care, not being a burden on children, sleeping well at night. That is what we are building. We are trading potential upside for certainty. The hardest lesson I have learned in 40 years. You only need to get rich once. Once you have won the game, stop playing. Selling these assets is not giving up. It is locking in, taking the chips off the table. Let's recap. We are removing illiquid traps, cutting speculative growth, diversifying concentrated positions, shortening bond duration, right-sizing our lifestyle. When you make these changes, you will feel a shift. The anxiety of checking the market every day will fade. You won't panic when news anchors scream about a crash. Why? Because you have built a fortress. You have aligned your assets with your reality. Take the next week to audit your holdings. Look at every line on your brokerage statement and ask, does this asset serve my future, or is it a relic of my past? If it belongs to the past, thank it and sell it. Retirement is not the end of investing. It is the beginning of the most sophisticated challenge of your life. Stewardship. Be a good steward of your capital. Protect it so it can protect you.